Okay. All right. Is that live? Oh God. Oh God. Okay. We've had a real trauma this morning with technical issues trying to get logged onto the live webinar. Um, it turns out that Google and Apple are not completely in sync with each other. I can't imagine what reason. So the different devices, different browsers, channels and users caused us a conflict, which has taken us all this time to resolve. So sorry for that. And we'll get into the thing now. I'm not properly set up in my studio as a consequence, but we can still do that, and we can get through that. You're just going to have to take me with glasses on just to support my note taking, because I haven't got it set up in a way that I can't do that. So here we go. We might edit that bit out later on. Thanks for listening. Thanks for joining us today at ProACT's Living and Working Abroad site. We're doing a series of emails and blogs which are looking at specifically capital gains tax for expats living and working abroad. And this is what we're aiming to cover now. So I'm using a different camera, so I'm having to get used to looking at the camera. So if I appear distracted, apologies for that. What we've done is we're looking at when capital gains tax applies for expats living and working abroad. And we're doing a series over this of 4 webinars looking at the specific instances of what it is and when capital gains tax applies and how much it's going to be, and what are the planning opportunities for an expat to organise their family's property and business and investments to pay the right amount of tax, but not too much. So planning to keep the profits of investments and business and savings with the family and not pay the tax man. So let's go into it. This webinar is specifically looking at when capital gains tax is applied. So if you've got any questions, go into the chat, ask those questions, and we'll try and chat in the answers. I've got my backup team online to support you. And obviously with Google's YouTube channel, we can come back to those questions later on to help support you. If you need any more information, we offer a free review and a chat live service at proactpartnership.co.uk. So come and chat to us and ask more detailed questions. If you do need advice and guidance, then obviously you can contact us at proactpartnership.com. So today's question is, when is capital gains tax applied? So what we're specifically looking at is in tax generally, when is capital gains tax applied? This would apply to any country around the world. Now there might be some exemptions, there might be some higher rates and lower rates, and different issues. We understand that. We're looking at it generally. Then we're looking at specifically on UK law and how that applies to expats and how it applies to UK residents. So expats that are leaving on the sale of business or property, for example, or expats that are returning, having completed a contract from a shorter or longer period of investment abroad, what is their tax impact and how is that going to work? So that's what we're looking at today, quite specifically. So first of all, we're looking at generally, when is capital gains tax applied? Capital gains tax is applied when something of value is sold. Now, that something of value can be anything. Can be anything that is a real value. So we're not talking about income that you've earned. We're not income that the company's earned, we're talking about a capital gain. So you could buy a share and sell it 10 years later to profit. That's a capital gain that can be taxed. You can buy a property that can increase in value. That can be taxed. You can build a business from scratch and sell it, or um, list it on the market for shares, and that is a capital gains taxable event. So, but also, if you make a collection of something that's rare and valuable, that in itself can become a capital gain and a taxable event. If you're making a cryptocurrency investment and you're selling out, that sale is a capital gains event. Okay, so it's important to be aware of that. And what we're talking about is when you invest in crypto tokens, and you exchange those tokens back into cash into your bank, there's a capital gains tax event. Now, if you're trading, where you're buying and selling cryptocurrency, that is not a capital gain. If you're receiving uh, uh, crypto tokens for investment, for sales, as a business income, that is income tax that is due for income taxes and social insurance. So cryptocurrencies are involved in income and capital gains tax. In this instance, with today's topic, it's if you're selling at a capital profit. So you need to keep a record of all your transactions for your cryptocurrency to refer and use those later on. Whenever that sale of that property, that company share, that business transfer on the stock markets, or that cryptocurrency or the investment holding, anything like that, it's a notable event, and the exchange or the registry or the broker or the agent will report that taxable event into the tax officers. And in this connected world, with anti-money laundering regulations and exchange of information between tax officers, it's important that you keep precise records so that you don't end up getting taxed twice or three times or at a higher rate. The worst thing for expats is you could be living in a one jurisdiction expecting to say pay 10% tax, and because you haven't reported it right or managed the sale and the assets correctly, you could easily end up paying 20, 30, 40% in another jurisdiction or your home country. The people that pay the capital gains tax is the registered tax beneficiary. And this is, again, it's an interesting area that's evolving with the anti-money laundering exchange of information. So if the individual holds the shares or the property or the business in his name and sells them, that is a capital gain for them. But the taxable entity could be your company, your holding company, it could be a family trust or a foundation, it could be a charitable trust or a foundation. There's lots of different ways of holding those assets for the benefit of someone. So there's many ways, many things that capital gains are taxed on, and you need to be aware of that and plan ahead, because these could be your life investment, and it could be your majority of your wealth, and you need to manage to protect your family and your income when you're living and working abroad and relocating overseas. As I say, if you've got any questions, contact us at ProACTPartnership.com. So let's move on more specifically now. What I want to look at is, from the point of view UK, what do they specifically tax for capital gains? Because there's some interesting changes that have been made since April 2020 on property, for example. So what the UK have got exemptions for expats, but it's not universal anymore since April 2020. So we need to look at that. The one good news is is that lottery wins, premium bond wins, remain capital gains tax free. So anything that you win on a lottery or in a betting shop or in premium bonds is capital gains tax free, as is investing in UK government gilts. But then everything else, as we've said before, company shares, dividends, company shares, not their dividends, the sale of the shares, investments, property, and business, all those and valuables all come under capital gains tax. Now, if a business is being sold between the partners, then it's still a taxable event. If the assets are held by an individual, there's always one type of status which is slightly different, and that's when they're a married couple. So a married couple in law generally and in English law are a legal entity which are the same. So if they own property or business in joint names, then transfers between them is capital gains tax free, as long as they're not divorced and they're not separated. So if you're living together in a business, you can give to each other and avoid capital gains tax. But once if business partners are not married, or if business partners are separated or divorced, or if property owners are not married or not or separated or not or divorced, then the gifts between the partners are a capital gains tax event. It's quite important there. So if you are going to get divorced, that in your financial separation, you make the gifts while you're still together amicably before you leave, because then you could have the cost and delay of a divorce plus a capital gains tax to pay. Never a good idea. And ISAs and PEPs in the UK as investment holdings never count for capital gains tax. So just bear that in mind when you're holdings. But those type of holdings can be held by people and created in the UK, but they're not things that can be held or added to. Sorry, they're not things that can be added to by expats living and working abroad. They can be held and sold without a capital gain in the UK, but they're not. They haven't got any other function. If you collect something and it accumulates a value, football posters, signatures, or something like that, those personal collections can be sold. They only become liable for capital gains tax if the sales value is over 6,000. So if you've got an old painting or an old piece of furniture that you sell for a couple of thousand, that doesn't even come onto the capital gains tax register. If it sells for 10,000, then you've got a liability there. So selling the family silver can become a taxable event as well. The big change in the UK for UK residents and non-residents, expats, is the same, is that capital gains tax was introduced to a much higher level on UK property. So business assets being sold are one thing, and those business assets could include property. Crypto exchange tokens being sold are a capital gains tax liability. But when something involves UK residential property, capital gains tax will apply. And it doesn't matter whether it's an individual, a company, a trustee, an estate, a personal representative, or holding company overseas selling the property. You can't make it up, can you? So don't have my studio. I'm not in my studio, and an alarm went off, which was going to disturb us. So there's definitely going to be a re-record of this video. so um, so from 2020, April 2020, all UK residential property is taxed, whether it's owned. The taxable entity is a company, an individual, a trust, a holding company, an estate, a personal representative, whether they're offshore or onshore, they're going to be taxed. In UK residential property, capital gains tax is higher than the normal tax rate. So UK will pay 10 or 20% capital gains tax, but it rises to 28% on residential property. So there are some ways to avoid capital gains on UK property, uh, but that is a very, very narrow window. And beyond that, everything is taxed, irrespective of whether the beneficial owner is an expat living and working abroad or whether they're a UK tax resident. So there's much to do to consider how you can avoid those profitable investments in UK property and business that actually now might fall under capital gains tax when you're selling them. So let's have a look a bit more deeply about how UK expats are affected with their UK capital gains situation. Any expat who sells a UK liable capital gains tax can defer the capital gains liability for up to 5 years. So if you're selling business assets or crypto tokens and you're an expat, you potentially can avoid that capital gains liability altogether. So by staying outside the UK for 5 years, this only applies to shares, share sales, business sales, investment sales, commercial property or business assets. So if you've got a business asset, which is an intangible asset because it's a brand or something that is beyond the it's not a physical asset, it's an intangible asset. It's a royalty, it's a license, it's a customer base, or it's a technology, or it's a fitting, it's factory fittings or what have you. All those business assets can be potentially exempt from capital gains tax if when sold by an expat. What an expat can't use this 5-year deferment to avoid capital gains tax for is UK residential property, and it doesn't matter whether it's a property that's fully residential or whether it is partially residential. Even if it's a company, if the business assets are the underlying holdings, then there's going to be a capital gains tax liability on it in the future for that. So, and even if the expat needs to be careful that this exemption for 5 years, it generally today, when we get asked the question, we talk to clients in terms of it's 5 years, but in the past it's been 5 full tax years. So it depends upon what your dates and your movements are and what the type of assets are. When the property was sold, is there a gain? But UK property assets being sold now are liable for capital gains tax, and those capital gains tax returns do need to be submitted within a couple of months, 60 days of the conveyance being completed. Quite surprised they didn't insist that the capital gains tax assessment is not submitted prior to a completion of the conveyance. It would seem to make sense for the UK to do that, but they're not doing that at the moment. They're doing it pending that. So we'll see if that changes in future years. So an expat leaving the UK has potentially got the opportunity to defer any capital gains tax liability on many capital gains events, but not involving UK residential property, even if the beneficial owner is offshore, even if it's a company or a holding company or what have you. So there are different strategies that need to be adopted for UK residential property investment, not least when the purchase is being made. So we can consider that later. Essentially, if you've got a holding of UK property and the use is not own and main UK residential property, you should plan and anticipate paying capital gains tax up to 28% on that, unless you do something which is within the guidelines and the rules. Expats, non-resident expats returning to the UK and using the split year rules, I've still got some interesting questions to address. Anybody who's a UK resident or returning expat has got potentially a liability to foreign income. Now, all UK tax residents have got a liability to income and capital gains and foreign income, but they've also got a liability when they're doing a split year. You've still potentially got that liability to gains over foreign gains as well, but the split year can protect you from foreign income. So this is the key issue. So if you've got a gain from abroad on a split year, you can still potentially be liable for double taxation on that capital gain back in the UK, coming into the UK. However, using the split year rules, you can use it to protect income that you've earned abroad up until the time that you come back into the UK. Any income after returning to the UK can be earned can be taxed in the UK, but only from the date of your return. You effectively get your split tax year is the tax year split in two mini tax years, one for abroad and one for the UK. And it protects those gains and income over the two periods. If your days in the UK or your years in the UK, if you've only been outside the UK for a short period of time, then you can get a scenario. Where the tax liability becomes due anyway. So you could be trying to claim the 5-year rule to avoid the capital gains tax, but it doesn't work in the essence of if you've only been out for a short period of time. So if you're on a short contract of a year, 2 years, and coming back to the UK, having previously lived and worked in the UK, that foreign earnings or any foreign gains could still fall under a UK tax liability. So you need to consider that quite significantly. Okay, so what we've looked at today is when capital gains tax are to be applied. What we do for our retained clients, we'll have a deep dive specific email which looks at a vlog and worksheet and guide that you can get access to at no additional charge. The live webinars you can attend and get the general overview. If you've got any questions, you can contact us at proactpartnership.com. You can go along to our website and chat with us live and get a book a free review with one of our advisors at proactpartnership.co.uk. Anybody that's listening through our initial technical errors, apologies again. We'll do a live rerun and we'll share that on YouTube, and we'll show it directly to all those that are registered and are subscribing. So thanks for listening, and we'll see you again next time. Contact us at proactpartnership.com if you've got any questions about living and working abroad. Thank you.